Okay, let's say you have heard about investing, you have some money saved up which you want to invest, but you have no clue where to start. You might have also heard about stocks like Tesla, Apple, Amazon, and how if you invested in these stocks 10 years ago, you would be a millionaire by now. But you don't really understand how all of this works. How do you even buy an Apple stock? Do you just go to apple.com and purchase a stock? You might have heard people talk about how someone they know lost all their money in the stock market and you don't want to lose your hard-earned money. Well, you're in the right place. This is a complete beginner's guide on how you can start investing, a video which I wish I had seen when I first started investing. In this video, I will take you through everything you need to know before you start investing, and I'll show you how easy it is to start investing with as little as $5. I highly suggest that you watch the whole video, but if you want to still skip to a particular part, here are the timestamps on your screen. Before we jump into investing, let's look at what an investment actually is. So by definition, an investment is an asset or item acquired with a goal of generating income or appreciation. In simpler words, an investment is something that puts money into your pocket. There can be many different types of investments like stocks, property, cryptocurrency, fine art, watches, and the list keeps going. But for the purpose of this video, we will just stick to investing in stocks. So first things first, why should you invest your money? Let's try to understand the concept of inflation and what happens to your money over time. In the year 2023, the current rate of inflation in Australia is around 7%. Let's say it costs you $100 today to get a full tank of petrol for your car. So because of inflation, in 1 year's time, it's likely going to cost you $107. That means your $100 are going to be worth less 1 year later than they're worth now. So technically, your money keeps losing its value over time. That's inflation. Let me show you a quick comparison of keeping cash versus keeping your money in a high interest savings account versus investing your money. We'll take up the same example again. Let's say right now it costs you $100 to get a full tank of petrol and the average rate of inflation in your country is 7%. Now let's say today you put your $100 in cash in your drawer. So in 10 years time, the $100 you put in your drawer will remain unchanged. You'll still have $100. But in 10 years time, the cost of petrol because of inflation would have gone up to $196. So if you kept your money as cash in your drawer, it would have lost almost half of its value because now you can only buy half a tank worth of petrol with that money. But what if you put the same $100 in a high interest savings account which gives you 5% interest annually? Let's see what happens then. At the end of 10 years, because of the 5% interest you get annually, you'll have $162 instead of $100. That means you would have earned an extra $62 just by keeping your money in a high interest savings account. But again, as the rate of inflation is always higher than what the bank pays you as interest, your money will still not be able to get that full tank of petrol. So technically, by keeping your money in a high interest savings account, your money has still lost some of its value. Now let's look at the third scenario where you invest that money in an index fund which gives you around 10% return per annum. In this case, at the end of 10 years, you will have $260. So that means you can still get a full tank of petrol for $196 and still have $64 left to spend. So that means your money has gone up in value by investing. I hope this example helps you understand that why investing your money is better than saving it in a bank account. So here are some of the things you need to know before you start investing. So the stock market fluctuates regularly. That means it can go either up or down in value periodically. So you should not be investing the money that you might need in the next couple of years, as if you need to sell your stocks when the market is down, you may lose some of your money. Historically, the stock market has always gone up with time. So if you keep investing regularly for a longer period of time, the chances of you losing your money are pretty slim. Now let's quickly look at the S&P 500 index fund, which basically tracks the biggest 500 companies listed in the US. So if you started investing in 2020, right before when COVID hit, the stock market fell sharply. And if you sold then, you would have lost quite a lot of your money. We can see that the market rebounded very quickly. So if you were investing regularly, you would have made a lot of money by now. So in order for you to not withdraw your money in the short term and maximize your gains, here are some of the things you can follow. The first thing is, if you have any high interest debt, pay that off first before you begin investing. So if you have any high interest debts such as credit cards, personal loans, etc., generally anything with an interest rate in the double digits, try to pay that off first. as the money you will be earning from your investments is likely to be less than the money you'll be paying to the banks as interest on those high interest debts. The second thing is always have an emergency fund. So before you start investing, make sure you have some money saved up which can last you anywhere between 3 to 6 months in case of an emergency. So this is really important because you might lose your job or an unexpected expense might come up and you don't want to be selling your stocks at a loss to cover for that expense. So think about how much money you spend every month on rent, food, bills, etc. and multiply the number by 3. So that's the minimum amount you should have in your savings before you start investing. A good idea is to keep your emergency fund locked up in a high interest savings account. So when you need it, it's easily accessible and it's also earning a high interest. I will link some of the top interest paying savings account in the video description so you can have a look. A quick disclaimer before we go any further. I'm making this video for the sole reason of educating my audience, and nothing I say in this video should be considered financial advice, and you should always look at your personal circumstances and do your own research before making any financial decisions. So we all want to invest in stocks and make money, right? But how do you make money from investing in stocks? So there are 2 ways in which you make money by investing in stocks. So the first one is capital growth or an increase in the share price. Now let's say you bought 10 shares of Apple for $100 a share, and after 1 year, the value of an Apple share has gone up to $150. So now your 10 shares will be worth $1,500, and if you decide to sell your shares now, you would have made a $500 profit. This is called capital growth. So the second way you make money by stocks is dividend or a share in company's profit. Now let's say you didn't sell those 10 Apple shares you bought a year ago. And in the last 6 months, Apple has made a big profit from selling all those different iPhones. So Apple decides to share some of the profit they've made with the shareholders. Now this distributed profit to the shareholders is called a dividend. Now if Apple decides to pay a $2 dividend per share because you hold 10 shares of Apple, you will receive a $20 dividend. So how do you actually buy these shares that we've been talking about? In Australia, all publicly listed companies are listed on the Australian Securities Exchange, commonly known as the ASX or the stock market. To buy stocks for companies listed on the ASX, you need to do this through a broker. There are many different brokers available in Australia to buy and sell these stocks, such as CommSec, NABDirect, etc. Most brokers in Australia will let you buy shares above $500 and will charge a small brokerage per transaction. In this example, we can see how much CommSec charges you per trade. So if you buy a stock worth up to $1,000, you pay a flat $5 fee, and it keeps on increasing as the total price of the trade goes up. But if you're a beginner, this can seem very difficult and you might not even want to invest $500 directly. What if you want to start small? Don't worry. Later in the video, I'll show you exactly how you can do that. For anyone who is new to investing, I always suggest that you start off with some micro-investing apps like Raiz, CommSec Pocket, etc. These apps take all the hard parts away and make investing as simple as buying a cup of coffee. In the next part of the video, I will show you the Raiz Invest app and I'll show you how you can start investing using that. So, how do you get started with Raiz? When I was a beginner, I started investing with a micro-investing app called Raiz Invest. Back then, it was an app which let you round up your daily expenses and invest the spare change. For example, if I bought a cup of coffee for $3.50, Raiz would round it up to $4 and invest the remaining 50 cents on my behalf. But now, Raiz is much more than just a spare change investment app. I'll show you the app in detail, but first let me explain some of the things which I'll be talking about while showing you this app. The first one is index funds or ETFs. So index funds are basically investment options that track performance of different indexes such as the ASX 200 or the S&P 500. So ASX 200 comprises of the largest 200 companies listed on the ASX, while the S&P 500 tracks the largest 500 companies listed on the US stock exchange. So if you're buying one share of the ASX 200 index, that means you're buying very small parts of the largest 200 companies on the ASX like Commonwealth Bank, Woolworths, BHP, etc. So generally speaking, the economy of a country always grows. So even if some of the companies in the ASX 200 index don't perform that well, the other companies are likely to cover up for them and the index will continue growing. Now let's quickly look at the breakdown of the S&P 500 index. Now, if you look at this chart, it shows you what's the breakdown of the S&P 500 index. So if you buy $100 worth of S&P 500 index share, you will be buying $7.16 worth of Apple, $7.10 worth of Microsoft, $3.36 worth of Amazon, $2.90 worth of Nvidia, and so on. So you're not purchasing a single company but little pieces in multiple companies. This makes index funds very stable and a safe option for beginners. So now that you know what an index fund is, let's quickly talk about ETFs. An ETF is an investment option that tracks the performance of a market sector, index, or commodity. A good point to remember here is that index funds are never directly listed on the market. So let's say you want to buy the ASX 200 index fund. An easy option for you would be to find an ETF that tracks the ASX 200 fund and buy that instead. Now, with the Raiz app, you can buy many different ETFs that track index funds from around the world. So, how do you get started with Raiz? The first step is signing up for the Raiz app. I've put a link in the description, so if you click on the link, it will directly take you to the sign up page for the Raiz app. So if you sign up using the link in the description, both of us will get a $5 reward, which will be directly invested into our Raiz accounts. You do not need to sign up using my link. You can directly download the Raiz app from the App Store as well and sign up using that. But if you do use the link in the description, both of us will get a $5 reward. So once you have created an account, you will be asked to add a spending and a funding account. If you want, you can directly skip the spending account part and just add a funding account, as that will be the account used to deposit money into Raiz. Once you have linked your account and verified your details with Raiz, you're good to go. On the home screen, you will see 3 tabs on the top: past, today, and future. By clicking on the past tab, you can see all of your transactions from the past and any pending transactions. It also shows you how much money you have invested, how much money you have earned from dividends and from the market. Dividends are automatically reinvested into your portfolio. So if you want to check how a particular dividend was invested, you can simply click on the dividend and it will show you the breakdown. The Today tab shows you the performance of your portfolio over time. If you click on the performance details, you can see how your portfolio has performed over time. The green line shows you the money invested by you, and the white line is the market value of the portfolio at that time. So if the white line is above the green line, that means your portfolio is making money. To view and set your investment portfolio, click on the Invest button. Here I've created a custom portfolio for myself, but you can choose a predefined Raiz portfolio to start off with. If you click on a portfolio and select any standard portfolio, it will show you the breakdown of that portfolio. Let's look at the aggressive portfolio as an example. Here we can see that the Australian large cap stocks STW make up 54% of this portfolio, while the US large cap stocks just makes up 5.4%. I know that the Australian large cap ETF STW tracks the ASX 200 index fund, that is the 200 largest companies listed on the ASX, while the IVV US large cap ETF tracks the S&P 500 fund from the US. But if you don't know what each of these funds consist of, you can simply Google their code and it will tell you everything. Let's try finding some of this information about STW. So when I pull up STW on ASX website, it shows me all the information about that fund. Under the share description, I can see that it tracks the ASX 200 companies. We can see that the last dividend was $0.96 per share and the annual dividend yield is 4.76%. This means that if you have invested $100 into STW, you'll receive approximately $4.76 in dividends each year. So once you have selected a particular portfolio, any investments that you make in the future will be invested according to your selected portfolio. When I first started investing, I used to invest in the aggressive portfolio as it provides a good mix of funds and it is a very safe option. If you look at my portfolio now, it consists of 5% Bitcoin, 5% Raiz Property Fund, and 90% ETFs, which are as follows. Under the Invest screen, you can set up regular investments, for example, $100 every Tuesday. This will automatically invest $100 every Tuesday, and the money will be deducted from your nominated bank account in 1 to 2 business days. When you make an investment into your Raiz account, it generally takes up to 2 to 3 business days to be fully invested, as Raiz first deducts the money from your account and then buys the shares on your behalf. The same process happens if you decide to sell as well. The money takes around 2 to 3 business days to reach your nominated bank account. Now, I won't go into other details about the app, as it can be a separate video on its own, but do let me know in the comments if you want me to make a dedicated video on the Raiz app. Well, it has been a really informative video and we have learned a lot today. Let me know in the comments what are your key takeaways from today's video.